Hey everyone, welcome to another episode of the Macrovisor podcast. I have a special guest here, Jason Perz. Jason's a longtime friend of mine. We've discussed trading, we've discussed the economy, we've discussed everything in between. We've had a lot of fun off mic, but we also like to have fun on mic. Jason, how's it going? Thank you so much for joining me.
Oh, great, man. It's off the mic today. It's been great chatting with you already. I think we got a lot of fun stuff to talk about. Market's been quite interesting lately, so there's a lot of things to talk about in every direction. As always, it's just great to catch up with you.
Yeah, it's great to have you on, my friend. And I remember we had a lot of fun talking last time about some of the kinds of swing trading techniques that you employ. I thought this time we'd zoom out and look more at the first half of this year because it's just behind us. We're recording this on Saturday, July 1st. So we just
Mhm.
closed out the first half of the year. It was a really interesting first half. By some measures, I believe it was a NASDAQ 100, had its best first half performance ever, which was
Mhm.
pretty crazy, and I think it kinda tells the story of the market we're in, doesn't it?
Absolutely. The NASDAQ has been a good trade. And for me, it was, I got long the NASDAQ very fortunately. It started to show relative strength early in the year. And then it just kind of continued to be the outperformer so far, which is how good trades usually happen for me. I don't think my good trades happen because I'm sitting there and thinking so much. I think most of the time my good trades happen when I'm going, the environment looks like blank. For example, the environment looked like yields should start dropping. The Fed could stop raising at some point this year or pause. Um, there was going to be smaller rate hikes. Yields in the long end of the curve stopped going up. They didn't really go the other direction, but they stopped going up. Other countries started to show some relative strength as well, like emerging markets like Mexico. So as all these, and Europe absolutely showed a lot of relative strength. So seeing that there was liquidity in the market, some of these things kind of coming in as well, and then going, okay, there's relative strength also in the tech sector. But also, I know what drives the tech sector, and when people would talk to me so much about, like, I can't believe you're long tech. Look at the breadth in tech. Look at this. I also got my ass kicked in 2017 thinking like that because the market gets so thin as the years go on that breadth doesn't work exactly the same. Like there, you got XLK is really the leading sector, which there's the NASDAQ, it's at 38% for the year, and the XLK is over 40% for the year. And so when we look at both of these, we go, what's really driving this? XLK is mainly, you know what? I'm going to actually look it up because we should get the exact numbers for this because XLK is, I think it's around 50% of Microsoft and Apple at the moment. And so,
Wow.
yes, so Apple is 23% of the ETF, and Microsoft is 22% of the ETF, and NVIDIA is 4%. So basically, you're talking like two stocks are 50% of this. The rest of everything else in there is under 4%, under 2% mainly. But you're talking about the two biggest stocks in the world basically pumping up the tech sector. And if we even go a little bit further, let's look at the Qs, which is the NASDAQ 100. If we look at the NASDAQ 100, once again, they're the two biggest ones, which is Microsoft and Apple. Microsoft being 12%, nearly 13%, and then Apple being about the same, 12.5%. NVIDIA being behind that at almost 7%. So, I mean, it's like, you look at that and go, okay, well, is this a good rally? It's like you could click the smaller stocks into it and go, there's only these two holding it up. So obviously this thing's going to crash. And only thing I've learned over the years is that I can't look at it that way. As there's people always talk about the crazy times in the 60s. There was a thing called the Nifty 50 stocks, and these were like the IBMs and so on of the day, and they were the can't lose stocks, and everybody bought these stocks, and they were never going to go down. And once again, same thing like today or 2017 into 18. These stocks are going to be the leaders forever and ever and ever. And basically, everybody got crushed in those stocks just after that. And it's kind of the same thing today, but it's more like the Nifty 50s. People forget people made a lot of money in those.
Oh yeah.
And it's the same as the fangs now. Like, people can make a lot of money in these. This is a trade. So once again, as traders, we have to understand that even though we might not agree with the fundamentals sometime, or we might not agree with the way things are working, sometimes only a couple things are dragging this whole thing up, especially when the weighting is so skewed these days. This isn't normal. Like, in
No.
history, like, this is the largest weighting, I think. I don't know that for a fact, but I
It's
can't think of a time where there was larger weightings in the major indexes than today.
it's very close to. I believe we may have broken the all-time highs recently, especially with Apple hitting $3 trillion. Top five S&P stocks right now are about 28% of the total market capitalization of the index. So, that's just five
Wow.
stocks. The other 495 have to take a back seat. If we look at the bottom 493, though, if we discount the Magnificent Seven that have really been leading this market higher, they're only up about 3.5, 4%. And if we actually zoom out a little further with the top 15 leading stocks, and we look at the other 485, they're only up 1%. So it is a
Yeah.
very interesting environment, right? It's easy to be in this market right now if you're not in the winners and actually not be making any money. And the amount of weighting that's happened in terms of just concentration in these really, really big mega cap stocks. Apple's now 7.5% of the S&P 500.
Yep.
Microsoft is 7% of the S&P 500. Amazon's 3%. Nvidia's over 2.5%. It's amazing how big they've become. And as we were talking about off mic, there's been reclassification to kind of push these around and sort of like throw Amazon into discretionary or retail,
Yep.
right? For example, or throw Google into communications and Meta, because why not?
Yep.
But these are all
Yep.
tech companies, aren't they?
Yeah, so if we're looking at that in just in the simple context of going, okay, well, what is leading the markets right now? And let me pull that back up, and we look at, okay, the top S&P sectors, XLK, which is tech, obviously. Everybody knows that. XLY, consumer discretionary, which is really Amazon.
Yeah.
So
And
Amazon's doing
Tesla.
well. Yeah, and Tesla. So great. Communications. Let me throw that on there. Oh, that's actually above consumer discretionary. That's at 36%. So it's, you basically can pick from tech or tech or tech, and you've done pretty well. Yeah, some industrials are starting to pick up now and so on, but there's also energy is down, utilities are down, financials are down on the year. XLP is nearly flat. The Dow is up 3%, but there's also a lot of Apple and Microsoft are in that as well.
Yes.
Emerging markets is at 5%. XLI, now we're back up to 10%. So basically anything that we're looking at in the market, isn't clearing 10%, while tech's up 40. And that's only based on those two major or three major stocks in there. So I think it's important to also be able to gather just general information of understanding like what's in these things. And it's also the reason why I don't trade individual stocks. And the reason why is years ago I started to look at the ETFs and going like, when ETFs came out or people started really trading them heavily, everybody hated them. Everybody said, oh, these are terrible, it's a terrible idea. For me, ETFs, the indexes, I love them. And the reason is because if you look at the way they're built, they buy strength over and over again. So my general idea of trading is that trends persist, relative strength is important, and so on. So as these things are moving up, basically what they do is they have a heavier weighting in the strongest stocks over and over again, and they kick out the weakest stocks. So basically it's riding winners, kicking out losers. This is the reason why you see a lot of like the S&P 500 had the same stocks it had in it when it started, like the S&P 500 would be worthless. But
Yeah.
because it rotates and because it gains new members and so on, now it continues to move up. So it's riding the winners. So even though like if you're buying individual stocks and you're having trouble, and I think buying individual stocks and being a very good individual stock investor is really tough. And for me, trading all these different markets, like I trade different countries, I trade different commodities, different currencies, crypto, whatever can be traded, I'll trade it. But picking individual stocks, especially when you're getting that small cap, micro cap range, like it's very hard. It's a very tough business to get into. It's very tough to make that consistent. I don't think I have an edge in it. So I kind of stick to these things. And I think if you're learning how to trade, just trading the ETFs and trading things like that will be generally a little bit more helpful for you because they have more. I don't know. In BMX, we'd call it boo boo room, meaning you could, basically like if you're doing a wall ride and there's a nice landing on there that's a little bit bigger, like you won't land flat and hurt yourself, so you'd call it like boo boo room, and that's what I call it today because I haven't learned much past that in BMX. I haven't learned a better way to say it,
I
but
like
it's like
that. Boo room.
you have this little bit of room to mess up, and I think that's really important to have that room to mess up.
You mentioned that, and I think that's a really good, important point because when people are listening to this, they got to know you are a swing trader, right? You're looking at things over
Mhm.
longer time frames. That's really the time frames we're looking at Macrovisor here as well. Longer time frames are really important for the type of trading and investing that we do. And I love that going back to the earlier podcast we had together, you mentioned that relative strength in the NASDAQ months ago, that this was one of the
Mhm.
trades that you were putting on, that, you're getting into this because some of the things you were seeing coming together. And it's been an absolutely brilliant trade. And regardless of what's happening in breadth,
Mhm.
you were able to see that because of that relative strength and get in quite early and
Mhm.
enjoy, really the best first half of the NASDAQ that's ever happened. So kudos on that. But going back to Boo Boo Room, I think this is really important. I know a
Mhm.
lot of people get lured in by the idea of easy money in stocks and particularly in options, but there's actually much more risk in stocks, isn't there? Because
Mhm.
there's so much more that can happen to a single company that can make shares worthless in a matter of minutes.
Yes.
That risk doesn't exist in commodities. It doesn't exist in the indexes. It doesn't exist in forex. It really doesn't exist in bonds the same way, unless you're in really bad parts of the bond market you should avoid. So it's like one of these risks that I would also say, a lot of stocks go to zero. There's just a
Yes.
lot that just don't make it, and I don't think that's something that people necessarily appreciate as much as perhaps they should. But you should speak to that a little bit more because I think the idea of Boo Boo Room and this idea of like a cushion, making sure
Mhm.
that you understand the relative risk, because one of the things that I've always felt was really important about your approach was position sizing based on volatility. And this is getting to the point of that too, right? You're kind of like, well, some of these things are
Yeah.
so volatile, I can't quantify the risk. I'm not going to put it on at all.
Yes, exactly. I mean, trust me, I'm just like everybody else. See financial news, I see Twitter, I see all types of stuff and individual stocks sometimes. I look at a screen and I go, "Oh my god, this is amazing." And there are certain things I'll put on trades, but they're mainly like only if there is no such thing as an ETF in that sector or the ETFs are terrible. Like the oil tankers trade I had a few years ago, I basically sized it so it was kind of like an ETF, and also with my trend following models it would kick it out. So I don't usually trade individual stocks at all, but in my retirement portfolio I do, but that's it. But for my portfolio that I'm trading day to day, my portfolio that I run for other people in the managed accounts, none of that is anything that I use individual stocks on. And I think a lot of people, I've heard people. It's very easy to get drawn into stocks because there's a big story behind it. And I think if you look at something like QQQ or the SPY or XLB or XLE, if you're looking at those, there's no real crazy bias that's going to come into your brain from it. And that's why I always say traders should start out with those, especially if you're doing ETFs, options. Especially if you're doing options, do not do them in individual stocks to start. Do them in ETFs. But if you're looking at something and going, okay, well, XLK, it's just tech. Like I'm not wed to Apple. I'm not wed to Microsoft, even though those you should understand what's in these things. I can just put on the trade and be objective about it as a trader. Like, once again, if you're a person who's trading fundamentals and you're a person who's doing something like that, you're going to have a different approach than I do. But if you're looking at relative strength, if you're looking at macro, if you're looking at liquidity, if you're looking at groupthink, if you're looking at those things like I look at, then you can kind of just come in and go, okay, this is like this is like that. And also, it's helpful when you're doing something like I look at COT reports a lot. I really like COT reports. I think they tell me a lot about market positioning. I think it's very important because if you're, take it to an extreme level, if you got 100% position on if everybody in the world is long gold, who can buy gold? Who can pump it up anymore? So and yes, that's extreme. That's never going to happen. But that's the point. Is that, and it's the same as we've talked about this before. In November 2020, I had a trade and everybody was short into the election. So at the very least, I know that there's not many more people to sell, so the market can't go down very much. And if it does go up, the risk to reward is huge.
Right.
So understanding all those things and kind of able to put together, okay, I like positioning because if I use just the major indexes, these commodities, these currencies, and so on, I can see the positioning of them very easily. And when you get to individual stocks, yes, there's insider trading, there's all these things, but there's so much other stuff that goes into it. And I've watched people really struggle, like, over the years of being like, okay, like, for example, I worked with a gold mining fund years ago, and they would go and find these new companies, and I can't tell you how many companies just disappeared.
Yeah.
And that doesn't mean that they were bad people or bad investors or anything, but it's like, why put on that much risk? Like, why have the risk if you don't have to?
Yeah.
I would rather be betting on a 1% move in the S&P 500 up or down even than betting on like a possible 100% zero move in something else. You can lose 20% in the S&P 500 on a trade would be like your big drawdown, like if you didn't have stops or something. But if you have something on and like some new gold miner or a new energy company or a new tech company or so on, your risk is just too large. I think it's important to just always understand your risk being the ultimate thing in your trading has to be, I know this can go to zero. I know I could lose more than that. And when you're in something like futures, I'm never going to deal with a gap overnight. My overnight risk is, I can get stopped out overnight. It doesn't even matter. But if I'm in an individual stock that has earnings and that earnings, are terrible and it wipes 50% out in the stock and overnight, like, I can't do anything about that. My stops aren't going to matter. Nothing's going to matter. So then it destroys the volatility of my portfolio. My position sizing changes. Like, all these things can't change for me to be a good trader. So I have to do it that way.
And I think that makes a lot of sense for people that are out there, especially that are trying to figure out, how do I swing trade, or how do I do kind of longer term trading? The idea of individual stocks, like I said, it's attractive, but there's a lot of risk. And if you don't have a very strong bearing on the fundamentals going into it, and you're not buying more mature, stable companies, you mentioned new companies. I think that's a very important risk to identify as well, because a lot of new
Mhm.
companies have a very high failure rate post IPO. And so, I think it's important to look at this from the idea of, one of the keys to trading and investing isn't just making money, it's surviving, right? So that you
Yes.
can tell the tale and you can come back and go again. And obviously, we all want to have our capital appreciate. That's why we get into the game in the first place for the most part, right? But we also
Yeah.
need to make sure we have capital left that can appreciate. And I think it's very interesting the way that you look at this, because it is something for people to really consider. If you're looking at how you're going to manage the distribution of your risk in your portfolio over time, price is one of the variables, time is another variable, and of course, with
Mhm.
money, if we do take a loss, it sucks, but we might be able to work and make that money back if we have to, through trading or otherwise, but we can't get the time
Mhm.
back. So the other thing that's really
Yes.
important in managing risk that I think a lot of people lose sight about is how long they let something just slide. Maybe it's not going against them, but maybe it's not working for them either.
Mhm.
And that's one of the things that I see people get in trouble with is they'll just get stuck in a trade. So, as a trend trader looking at this, I know you have systems in place that would probably tell you this isn't going anywhere anymore. The momentum is gone. How do you manage time as a risk?
This is a great question. I don't think I've ever had it asked to me, but I have thought about it and I have worked on it. So, for me in trading, it's a great question. For me in
Thank you.
trading, when I'm looking at something and going, okay, this isn't working, I don't think anything of it at all. Now, I'll tell you why. In futures, I have too much leverage. I never go to I'm never fully leveraged, so I don't get a margin call or anything, but I have so much leverage that I could put on, every position I've ever wanted to, or probably just 30, 40 positions in whatever market I want to and call it a day. So when something is chopping around, and let's say, because I'm as a long-term trader, there's tons of positions I've been in that have gone nowhere for 2, 3 months and then have gone everywhere after that. Like it's natural gas being a good example
Oh,
of
yeah.
that. It sat and went nowhere. I have very wide stops on natural gas because the volatility is so high. So I'm sitting there with this very wide stop on natural gas. It's absolutely not going anywhere. It's just watching this thing chop around for 2, 3 months and then it explodes. And I always say like that you never know where your biggest winners will come from, and it's because sometimes that's going to be your biggest winner is that you put on a position, you're going, why isn't this going anywhere? Now, this is also a thing of once you grow your account. So if you're a new trader and you're going, I put on this position, it's sitting here for a little bit, I have to do something different. I have nothing wrong with that. But if you have a larger account where you can put on, or especially if you're in futures and you're using leverage and you put on a lot more positions, that changes the game a bit. That means that you're not really there's not an opportunity cost there. I'm not sitting there and going like, oh, I wish this was in something else. I'm going, well, I have the time. For me, I have the time, like, because I have the capital. But that took a long time to get to the point where I had the capital to do that. And that's okay. That's how most traders. I hope nobody trades with all their money. Trade small, trade with the least bit of money that you can at first. But as time moves on, if you gather more money, it's easier to sit in things like that. But I'd also say, if you have a signal and you're following a system and you're following your plan, and it's a trade that's sitting there for 2, 3 months, that's also something that if you're a position trader like me, like I'm swing to position, so sometimes I have trades that are on for years. Just really when I get stopped out of it. So it's if I'm going to put on those positions, I'm always going to follow my system and my plan. And I think one thing that's the most important thing that isn't even to isn't really in this conversation, which is just having the discipline, learning the discipline to just put on your position, walk away, whether it's chopping around, going up or anything. If it's not stopping you out, and honestly, like there's very few times where I have positions that are just sitting there and not stopping me out. Most of the time, if it's a bad trade, I will get stopped out of it. Um, but if you have that discipline to just put on the trade and be like, well, I'm not stopped out. It's cool. It gave me the right signal. I waited for relative. Let's say you're like me. You use relative strength. You use positioning. You have all of these signals kind of going your way, and then you get a price action signal, and it breaks out the right direction, and then it just sits there. I would sit in the trade just because the discipline to follow your plan is worth way more than getting out of a position and back into another one. You have to have the discipline to follow your plan or you will not do this well. And it doesn't matter what you think you're missing, because I think a lot of the time when I see people talk about things like this, they're talking about you're not talking about it this way at all, but they're like younger traders. When they just start trading, they're talking about getting in and out of trades. They're like, oh well, for example, I was in the Dow and the NASDAQ has gone up 40%. I'm just going to jump in the NASDAQ today. Like it's like that would be a bad idea. But if you're a person who's like, if you, let's say you also have the discipline and a plan, and your plan is also, once my trade has hit 30 days, let's say you're a shorter term trader than me, your trade hits 30 days and it doesn't go anywhere, I take off the trade. That could also be your plan and your discipline too. So I think there's a lot of ways to structure it. For me personally, like, I'm just going to put on the trade and wait. And there's very few times where I ever see a trade just kind of sit there for 6 months and not really do anything, with the way my risk management is set up.
That makes a lot of sense. Now, when we look at time as a risk, since we're now in a world where margin cost has gone up by at least 500 bips over the last 14
Yeah.
months, how do you look at that now? Because I know that I've talked to a lot of traders that are handling that, but differently, trying to keep less overnight and so on.
For me, I so as a position trader, so the shorter your time frame, this is also kind of important, and something good to study. I studied this when I first started really getting into futures. The shorter your time frame is, the larger positions will most likely be and have to be. Considering I'm looking for, let's say a product like the NASDAQ, I'm looking for 20% moves in something like the NASDAQ. If I'm looking at something like natural gas, it could be 100% move for all I know. Bitcoin, so with I have a 35% trailing stop on that. I'm looking for 150% on the major trades in Bitcoin. So I have very small positions. But if we're looking at like a day trader, now we're talking about your positions, or even an overnight or 1 week trade. Like, we're talking about very large positions, because you're only looking, if you're trading for 1 week in the S&P 500, you're mainly looking for 1 or 2%, maybe 3% moves. So now you're able to, put on that big position, look for a couple day moves, and that's it. So your positions have to be bigger. For me, I never get to that size at all. I'm always like, to really hit those risk management levels that I'm talking about, like a 1% loss for my portfolio on losing trades, and gaining on average about 5% of my portfolio on winning trades. I have to have very small positions to make those losses right. So most of the time, it's only like very few times I've ever seen where I've had tons and tons of positions on, because everything's giving signals, are the only time I'm ever going to get close to, a margin call. But for me, I'm not near it. I haven't had any trouble with any of that yet. And that's mainly just because I stay so small in comparison to what I have every time. So I think the biggest thing that people do is really over trading too big. I think everybody trades too big. I think if you're getting a margin call, that's trying to tell you something. Don't look for, if you're trading one trade, like, even if it's a day trade, like, you're using your entire account to trade one trade, like, that's insane. You could lose everything in one trade. So, you always be open to, hey, I might need a smaller size. For example, here's a great one. Alexander Elder, he would train traders, and he would go to New York and meet with different traders or different firms, and he would sit them all down. And what he would do, he'd find it was always the traders that were having trouble. And what he would do is cut their size in half. And most of the time, this would be enough to make them trade well. And then if they were still having trouble, he'd cut it in half again. And this would make them trade well. And this would work nearly every single time. And I think that every single person, like, because trading has so many different styles, I can't tell you to be like me and you'll make money, or be like Mayhem and you'll make money. Like, you have to really come up with your own strategy and your own style. But I do know that large size, the amount of stress it puts on your brain, your body, the world, like, around you, like, it's going to affect your trading. You're not going to trade well. Not to mention, if I have a trade in natural gas, and let's say, I have $100,000 account to make an easy number, and let's say I'm using $50,000 of that account on a natural gas trade, and that thing is, it's as volatile as it can get. So it's swinging down 20%. So it's wiping 20 grand, or sorry, it's swinging down 40% in a few days, like it can. So natural
Yeah,
gas is swung
it sure
down,
can.
40% in a few days or a week. So let's say it goes down, 30, 40% in a week, and you're losing $20,000 in a week. You're gonna stress about that. Like it's a smaller account. Like that's a big size. That's a lot of money. You just lost 20% of your account on one trade. You're not gonna be able to just hold on to that trade like you should as a swing trader or a position trader. But if you take that size and you make it so it swings down 30, 40%, and you're losing, $4,000, now you're talking about, okay, well, that's a lot smaller. That's manageable. That's still too big for what I think you should be doing. But once again, this isn't about me. But if you're doing something like that, you're going, okay, I lost $4,000 in a $100,000 account. It's natural gas. It swings to those type of levels. That's not going to bother you nearly as much as losing $20,000 or so on, or $40,000. So it's really important to have those sizes small where you're not using, 100% of your account. Like if $100,000 account, you have $100,000 trade in natural gas. Like we just said, 50% loss in natural gas means you lost half of your account. That's going to drive you nuts. That's going to make you crazy. That's going to make you trade badly. You can't hold on to trades like that. So you're just going to take, once it hits 50,000, you might just cash out right there and say, fuck it. But if it's at 5,000 in a $100,000 account, you might be able to just hang on to that, and be like, okay, well, it's natural gas. My stop's here. It's wiggling around. That's okay. And that's just the way it's going to have to be.
Yeah, and natural gas is such an interesting instrument to trade. I mean, I know we're talking about relative risk, and some people call natural gas the widow maker, and perhaps aptly so if people are trading with too much size and over trading it. But it is a vehicle that has been really interesting to trade because it is so high beta, and in relative risk terms versus the average stock, maybe not a blue chip or a mega cap, but the average stock, natural gas can actually be less volatile. And
Yeah.
certainly we know it's not necessarily going to go to zero. And if anything like that does happen, it's going to be very short lived. And the
Yes.
contract we're trading is Henry Hub, right? Or at least
Yep.
mostly that's what I trade is a Henry Hub contract. So there's actually some reasons to look at natural gas potentially constructively into a very hot summer as well, isn't there?
Yeah, and natural gas to me, I love any instrument that can give me some uncorrelated returns. Natural gas does not give a shit what anything else is doing in the market. It does not care if there's liquidity. It doesn't care if the Fed raises rates. It doesn't care if the Fed lowers rates. It just kind of does whatever it wants to do most of the time. And I think that's important to have in a portfolio, just something that can diversify you to a point where you're like, okay, well, this is just kind of doing what it's going to do. Bitcoin, I like Bitcoin because it diversifies my portfolio. Gold, same thing. Bonds, same thing. Like all of these things will diversify your portfolio. But natural gas, for me, I really like the base it's kind of carving out at the moment. I do have a new buy signal in natural gas. I forget which contract month, but I think it's September. And so it's carving out a base. It's starting to move up. It's showing some relative strength in the face of the market. I think it could be a very interesting time. It's just like you said. But for me, it's natural gas. I think just trading it in general is a you need a class on it basically because it's so volatile. It's so hard to trade. It's so frustrating at times. But once again, it's another trading vehicle. If something move, like I'm looking at the commodities right now, natural gas moved 3.2% yesterday. Oil moved 1%. Gold moved 0.6. Most of the time, the natural gas is going to have a much bigger move than everything else. So
Yeah.
if I put on positions in natural gas, I want to make sure, there's smaller positions. For example, if I need to have a 20% stop on natural gas, then I'm going to have in a $100,000 account, I'm going to have a $5,000 position, and that is it. $5,000, 20% trailing stop, that gets me to $1,000. Fantastic. That's a good trade. Now, once again, 20% in natural gas, that can happen any minute. So you might even need to have a smaller position to that, might even need $3,000 position, to get to that smaller size because natural gas can make such large moves against you. but really, like, it's a very volatile product. Another volatile product is Bitcoin. If you are a trader, like, you have to understand the volatility over everything. Like me and Mayhem have talked about a million times. It's if you're trading Bitcoin at $10,000 and you're trading bonds at $10,000, there's a huge difference in those two positions. Like bonds, a 1% move in a day in bonds in the 30-year, like that's one of the most volatile bonds. That's very rare. Like 1% days happen, but it's kind of rare. If we're looking at currencies, same thing. 1% days are kind of rare. In Bitcoin, 10% days aren't really rare. They
Yeah.
happen. So it's like, so if a $10,000 position in Bitcoin, your 10% stop is being $1,000. Like, that's it, you're done. Like like party's over, and that could happen in one day in Bitcoin. However, if you're in bonds, that 10% stop is perfect. You have tons of room in bonds to have a $10,000 position with that 10% stop. So Bitcoin, you need a 30% stop, and bonds, you have a 10% stop. So understanding the differences in those two, if you didn't understand what I said there, you feel free to reach out to me, or do something, but understand what I'm saying right there. That will save your trading and make you a good trader more than anything else, because we're always going to be wrong. And if you can make the math so you're able to be wrong and continue to make money, you're going to be a good trader. If you set it up, and I don't care if you're George Soros or Stanley Druckenmiller, like, you can't set up your risk in a different way than that. People always talk about those stories, right? Here's something that we hear all the time, and you've heard this too, which is the stories of Soros, and they're shorting the pound, and they all jump in and they go as big as possible and they short the pound. These are 1 in a million trades. They're talking about the trades, like, these dudes have had great returns for many, many years. Not to mention, like, Soros had that crazy, 10,000% return in that fund he had with Rogers all those
Yeah.
years ago. He never even talked about what what trades were actually in there, but he talks about the one trade in the pound, because it's kind of, that's what the things people want to hear about. When I talk about trades, everybody likes to talk about when I shorted oil to zero. Like, everybody loves that story. It's a good story. But once again, it's not how I made most of my money that year. Like, it's not how I am consistent. It's not how I do it year after year or quarter after quarter or anything. That's a whole different thing. So understanding that those are most likely you may never see a trade like that in your lifetime, where you're like, I know this 100%. And if you do see it and you feel like you know something 100%, you probably don't, and you're probably going to blow up.
Yeah, that's actually that's a really important point right there, right? This idea of self-certainty is usually what's going to get someone into the biggest trouble, no matter what their time frame is. You could be a day trader, a swing trader, an investor. When you're 100% certain about anything and you go max into it, and then
Mm-hmm.
add to the danger zone leverage, I mean, it can be a really bad time. And I've seen people do that. They get married to a story, or they get very, very high levels of conviction about something that they feel is in their analysis that may not reconcile with how things play out. And you've always got to ask yourself too, like, with so many incredibly smart people participating in the market, some of whom command an enormous amount of size, why would we assume that we're the smartest person out there and we've figured this out, no one else gets it, right? As Steve Cohen, he's pretty well known hedge fund manager from Point 72, and before that SAC, which had some issues, but still, got to respect the guy and his legacy. He says his best traders have about a 60% win rate. And so you got
Yep.
to look at that, right? Because at the end of the day, that's a really important thing to think about, is if you're getting upset with yourself as a trader or an investor for being wrong, there's nothing wrong with being wrong. It's
Mm-hmm.
about whether you're letting it lose money for you, particularly more than you should. And if you're employing what Jason's talking about, which is the crux of how I manage my trades too. I mean, every trader has to do this. Every investor has to do this.
Yes.
Everyone who participates in markets in any capacity has to be able to employ some kind of risk management that measures your sizing based on volatility. And there's a bunch of different ways to do that. You might use average true range. You might use implied vol, historic vol. You might use, a number of different measures, beta, et cetera, to figure out what that sizing is and what works best for you. You may back test different drawdowns over time, which is something Jason and I have done to try to figure out where stops should be. But at
Yep.
least do your homework to figure out your risk management and be okay with being wrong. The
Mm.
biggest thing that I've seen for traders that I think have a lot of potential getting in their way is their ego. And it's like, oh, I
Yes.
can't be wrong. I'm right. The market's wrong. And it's like, it doesn't matter whether the market's right or wrong. What matters
Mm.
is what it's telling you with price. So if you're
Yes.
in a trade and it's going against you, you've got to be able to say, you know what, maybe this isn't the time. Maybe I need to look at other things. And if you start getting emotional about it, A, it means you have too much size on. So that's your
Mm.
internal radar telling you, this trade is if you're keeping yourself up at night, if the trade is giving you thoughts when you're not even by the computer, if you feel the need to check every tick on the chart and it's not even a short-term trade, you've got too much size on. And you can't,
Yes.
and the other side of it, the other extreme is if you don't give a crap about how your trade does, if you're not even looking at it, if you don't even like check on it at all, that's okay if you know what you're doing and that's how you roll and you've got automated systems to contain your risk. But for most people, that means you don't have enough size on to care. Right. And so it all depends on how we approach things. Jason, you wisely said there's no one size fits all approach, right? Everyone's going to be different. So how we invest and how we trade should suit our personality type. We should,
Yes.
go ahead.
Absolutely. No, I was just going to add to what you said, because that's also the thing that I do see a lot that helps people when your size is so small that you don't really worry about each individual trade. Now, this is for traders with actual stops. This isn't something where I'm talking about somebody buying a stock and thinking that's going to go up in 20 years and they put 20 bucks in it. This is, futures trading or big stock trading. You have actual stops in and so on. When you are actually able to really walk away and really just trust your systems and trust it to manage the trade, that's going to be a good trade. And that doesn't mean you made money on that trade. That means you trusted your plan. You said, my plan is this. Some people's, they get in and out of trades based on fundamentals or something. If you're trading based on your entries are chart wise, you have a model that says I'm going to buy 100-day highs. You have a 20% stop on this, whatever it is, and you're able to just walk away and let it run. Sometimes that's going to be your best trades, because you're finally able to not fiddle with it too much. Like I watch so many people. I can't tell you how many people over the years, I see two different things happen. People will come up with amazing trades. And really, when you're a futures trader, a lot of it's a shotgun approach in a sense where you're putting on many trades. Some of them are going to get stopped. But if you're a systematic trader and you're going to continue to put on trades no matter what, you have to be able to just pull the trigger always. And so making your size small enough that pulling the trigger isn't going to drive you crazy, understanding your systems well enough that you have the faith in your system to let it run, and then, waiting for your exit signal and so on, and figuring out how you're going to do it. That's going to be how, you can really systematize your process. I see a lot in traders where they go in and they're like, okay, I have a really good idea. I have a friend, he's way smarter than I am. He's genius, but he overthinks trades every time. He came up with the uranium trade right before the major run, nailed it. He was out within a day. Yeah, I don't like it. They changed some policy in some country that I don't even know what it is, and I keep the trades on because I'm looking at it and going, okay, this is a good idea. I also like the way the chart is. Let's say, I'm buying the ETF in the sector. I'm going to put on the trade. I'm going to wait for, my trailing stop or my sell signal no matter what. I always put on trades and I don't care what happens. If Jesus came back from the dead and was like, he was like, hey, Jason, I've seen the other side. I kind of have this idea that, that trade's not going to work out soon. I'd be like, no, that sucks for you, dude. I'm going to continue with my trade. And that's really like how I am and how I trade. And sometimes, you know, there's going to be the fundamental guys that sometimes nail perfect tops. But I know for me, like that's not something that I can do consistently. I know nobody can make that consistent. They can't do it again and again. And if I can't do it again and again, it's not something that's going to make me money next time. So I will leave the trade on. You know, I've seen it in many trades. So you'll see a lot of people just kind of talk themselves in and out of trades. And I think a good approach is once you're in the trade, you're in it. You know, I don't care what happened. It's like the NASDAQ. I could have came up with every reason every day. And even in my own head, I'm like, I don't know why this is going up. You know, like I really don't. You know, like there's, you know, I have friends who, you know, they talk to me about the semiconductor trade, or I can't believe you're doing that. And like every day, like, you know, these are going to correct by 50%. And I'm like, well, that doesn't matter when you have a big gain, and also there's a stop there, so it's not like I'm going to lose 50% overnight. Um, so you know, you run into those things over and over again where people overthink the trades so much that they miss the good trades. And for me, it's like if let's say I put on the Nasdaq trade and it went against me, I lost 1% of my account. That's it. 1% of the account. So what does it matter? Like what the opinions and so on and all these things, they don't really matter. So you start to learn like you really trust your system. Opinions like that don't matter like they used to. You're going to put on your trades. So as over time, you just refining your own systems, your own strategies, how you're going to do things, what you think you did badly, how you could do that better next time. And really, that's when you start to get to the mastery point of trading and you're starting to just work on yourself internally. Because internally is really your biggest battle. Like you don't have to. I would always talk about when I rode BMX professionally, I'd always talk about like I would look in a mirror and just kind of talk to myself because like that's who I'm fighting. Like that's what I'm riding against, that person. I'm not sitting there, I'm not looking at the other person that I'm competing against or saying I need to be better than this guy. I'm always trying to be better than myself. And I'm trying to do like, even if you're the best rider in the world and you watch everybody else ride and you want to do something, you're still thinking about what you can do at your best. You know, no matter what, whatever sport it is, you know, LeBron James isn't going to turn into Michael Jordan, and Michael Jordan isn't going to turn into LeBron James. They're going to be two different players forever. So just understanding what's my strengths, how do I work on myself? What do I talk myself in and out of a little bit too much? Am I too headstrong on this? Am I not too headstrong on this? You know, like understanding those things about yourself is going to be how you can really get to that mastery point in trading. Because before that, you're really just kind of refining what's your methodology. And then once you come up with your methodology, then you can kind of get into that point of now I'm really working on myself and trying to figure out how I can get better as a trader.
Yeah, and I think it's a really important point about just putting it all together. It really is, and trading and investing really are something where we have to spend a lot of time looking inward, getting to know ourselves, testing our limits, you know, finding our weaknesses and trying to build on them so we can get better, but also realizing where we're strong and never being 100% satisfied with those strengths, continuing to exercise to build those muscles, that reflexive ability to say, look at a chart and know if this is an opportunity, or to analyze a situation based on the commitment of traders or other positioning and measures and say, is this an opportunity? You know, when people first get into this stuff, when you and I first got into this stuff, we'd look at this stuff and we'd be like, I don't even know what the hell this means. But over
Mm-hmm.
time, you start to build new neural pathways. You start to, you know, understand these things, not only like taking a couple, you know, minutes to analyze it, but almost at a glance, things start to stand
Yep.
out, you know? And this is one of the things, because I don't want people to be too intimidated with the process. One of the
Mm-hmm.
things that I think a lot of people get a little bit kind of pushed back by is, oh my God, these guys must spend like their entire lives just immersed in information and charts. And, you know, they just must like always
Not
be
at
doing
all.
this and have no life at all. And it's like,
Mm-hmm.
no, the reality is that you plug in, you find out what works for you, and you build systems so that you can automate as much of that workload as you can. And you can
Mm-hmm.
build on that capability that technology so generously affords us to go back and look at all kinds of different data sets and see how different trading environments affect different assets, the personalities of different assets, and how we can qualify entry and exit. And this is one of the things that I really like about how you trade, because you're much more systematic in your approach. You like you said, you set it and forget it. It doesn't matter if you read a headline that like, Apple's failing tomorrow as a company. You're like, well, if it fails, I'll get stopped out. That sucks for them.
Yeah, exactly. And, and that's the truth. I mean, honestly, like I could read any headline and it's not going to change it. And like the one thing you learn over time is that, a lot of the, people in general, and I just made a post about this on my page, which is the Milgram experiment. And you have the Milgram experiment where they were trying to figure out why people would possibly follow the Nazis to gas these people and kill these people and so on. And so they did these studies where Stanley Milgram took people and he put a random person in, and it wasn't a doctor, just a random person in a coat that looked like a doctor's coat, and just said, "You're a part of this experiment. We need you to shock this person if they get answers wrong." And they would be shocking the person, and the person would be like, "I'm dying, I'm having a heart attack. Please stop shocking me." And they would continue to like ask him questions, and they'd ask him a question, and the person wouldn't be answering, signifying that they're actually like dead, possibly. And they would be like, "Well, you have to shock them," and they'd be like, "Okay," and they'd continue to shock these people. And so like it was obviously a setup. Like there was no person in the other room getting shocked, but they thought there was.
Right.
So it's like people in general, when they watch something like CNBC or CNN, like they grasp onto these people and what they're saying and the headlines behind every news article and so on. And you don't know whether that person on CNBC or that headline is somebody's book. Like if somebody's short than that, like for example, easy example, hate to call out, another company, but Hedgeye, just because it's an easy example and I don't really know another one to say. I have a friend who has their service, and he was like, "You have any signals that are, short the NASDAQ right now, quant signals?" And I said, "No." He said, "Well, how are these still in short signals?" And I said, "Okay, well, let me just double check." And so I went over 200-day high signal, which is like one of the longest term trend following signals for quants. And then I went over, 200-day moving average, obviously, just simple signals and so on, and, crossover signals and everything. And I went probably through like 30 or 40 systems, of the most popular systems. And, I even went to long-term, like monthly charts and Bollinger Bands and volatility signals, because there are vol expansion signals. All of them were in long signals. But this person at the same time is saying that the NASDAQ is in a downtrend. Like, and they're not talking about their fundamental reasoning, they're talking about their quant signals.
Right.
So my point isn't to make fun of them. That's fine. They can do what they want. But it's to say sometimes when you're paying attention to these things, sometimes when you're seeing these things on the news services or a certain newsletter or somebody's service, understand that they might be talking their book a little bit. They might be, trying to pump out certain information for their own gain, or they're just talking about certain information because they want to believe it's going to happen. Like if you've been talking about being short the NASDAQ while it's gone up 40%, that's pretty damn damaging to you. So you're going to obviously want to say, well, it's going to happen soon. Like the short, you guys are going to miss it if you get out of it. Like that's fine, but I've been shorting it for, the last 40%, but it's going to crash, another 80% tomorrow, like, so you're going to continue to build up this echo chamber in your own head. So my point is, just don't get too stuck into things like that. And it's okay to have the idea that you don't like the NASDAQ fundamentally. Like I don't even like the NASDAQ fundamentally. But if you're looking at it and you're trying to say this is a quant system and I'm long this because of the trend, or I'm short this because of the trend, sometimes people will straight up lie to you. Sometimes people don't really care. The only thing you can know for sure as a trader is to find good services, like Mayhem, that really kind of give you the information and tell you, here's all the information. This is what I'm thinking. And then you can put up your own things with it. And then on top of that, understand, what do I do as a trader? I'm a trend follower. I don't care about the fundamentals. If I see the NASDAQ is in an uptrend, I think it's in an uptrend. That's where I go with. I can be wrong on that, but that doesn't mean I do something differently.
Yeah, and I think that's a really good point about, just focusing on the signal, focusing on the system and making sure it works. If we get distracted, if we find that, we're letting outside influences impact how we're trading, then or how we're investing, then that can create a lot of problems and we can become less consistent. We can have interference that means that we're not really understanding if our system is working the way it should because we're making decisions outside of the context of the system. Like no system is going to say, yeah, like go with the trade unless this guy on Twitter says something bad about it. Right?
Yeah.
There's no stop out because some big account says, well, actually I hate Microsoft and it's going to zero. Like the reality is that when we get into one of these things, we do it because we should have a system in place. We should have a way of understanding if that system is working or not, how we're managing our risk, and where we're going to potentially get out. What signals that? Is it a particular price? Is it a change in momentum? Is it something else that's happening in positioning? I mean, everyone has a different approach to the market, but at the end of the day, data is our friend. And there's an
Yes.
abundance of helpful data out there that can
Mhm.
help, that can guide our decision and allow us to be a little bit more objective. So yeah, I do appreciate the call out because that's what we
Mhm.
try to do at TraderAid and at MacroVisor is provide actionable data and information, but also not come away with an entirely biased conclusion about what we're seeing, but more share what we think this could mean and how this may set up probabilities. And I think that's really what
Mhm.
trading is about. It's about probabilities. It's about assessing how likely it is that an outcome may happen, and then if it looks like it's a very high likelihood and there's that outside return versus risk potential, and it's essentially a setup that looks conducive to our process, then that's an opportunity, no matter what, qualifying it in those general terms, because that way different systems can still be kind of defined in those general terms, right? So you might have folks that
Yes.
trade off fundamentals or trade off macro or trade off technicals or trade off positioning. But at the end of the day, just the biggest thing that I would say to everyone that is trying to get more fluent in the world of finance is don't spend a lot of time questioning yourself, and if you're going to do that after the trade so that you
Mhm.
can do it during your post-mortem and understand why it worked or why it didn't work or how it could have worked better. But don't do it while you're in the trade because you're going to expend mental capital coming up with hypothetical scenarios that don't matter. Because if you have good risk management in place, then what you should be doing at that point is looking for your next trade, looking for your
Yes.
next opportunity. And one of the things that Jason and I spend a lot of time on is trying to find ways to, improve our signals, whether it's
Mhm.
iteratively or identifying new signals, finding new asset classes that might be worth trading. And I would recommend that people think about that look, it's tempting to get stuck into just one thing, and some people get really good. And I have nothing wrong with someone who just trades S&P and that's their bread and butter and they make tons of money doing it. Good for them. But I'm a little restless. I don't like trading just one thing. There are different regimes where I might not even be interested in trading something when it's in a certain type of regime. Like if the stock market's going sideways, I don't necessarily want to trade that kind of market. It's not very exciting. But if it's moving, then that can add excitement. Similar with commodities or
Mhm.
bonds or currencies, it's got to have some momentum, some direction to make
Yes.
it attractive. And I think that's the other thing. Like some people might then take issue with that and they could say, well, look, I'm a range trader. That's where I do well. Well, good.
Yep.
Then you know
Great.
yourself and like go kill it. Find lots of ranges to trade because that's your environment and that's when you excel. But like that's
Mhm.
the thing. And this is the thing that and we can kind of wrap it up here, but this is the thing that we see a lot on social media that I find to be so unfortunate because everyone thinks that they kind of are reading into someone else's shortcomings or weaknesses, or they create these fallacies like this person can't be a good trader because they've said this or they've done that. The reality
Mhm.
is that everyone's so different that to look at people in that context, and unless you have very specific repeatable examples through time that show that they're like really just don't know what they're doing, most people are on such different time horizons and such
Yes.
different trading styles and approaches that you can't possibly really know, and particularly if they're not even announcing it all. Like if people aren't putting everything they're doing in their portfolio on Twitter, you're going to have no idea. So take a step back and realize that social media is actually one of the most amazing places to learn from other people. Whether it comports with your personality or style or not, doesn't matter. There's always room for growing our awareness, our knowledge, and our skill base, right?
Yes. No, absolutely. And that's a good way to end it, because it's the more that you can be open to understanding and identifying what works for you. Even if it's, you find, like, I find that if I find newsletters, especially, or analysis, or traders with good analysis that can help me with and my time frame, that's going to help me a lot more than trying to find somebody that's not in my time frame at all. So most of the time, if you can identify what these people's time frames are, what they're doing, you're going to do a lot better and understand them a little bit more. I have people who, they talk shit on me all the time. I mean, I started calling my letter the unsophisticated investor just because some dude kept making fun of me and telling me how unsophisticated I was and how I shouldn't be trading because I look at the charts. Like, it's funny to think about that, but it really is, for me. Sometimes that's the way it goes. Like, it's simple. Trading should be a process that becomes a simple process. At the beginning, it's a hard process because you're trying to identify what you can do well. So you're learning different terms, you're learning different terminology, you're learning why this might work this way. It's very hard, and like you said, like, don't get too overwhelmed by that, because everybody starts there at the point where everything's way too overwhelming and they have no idea what everybody is talking about. And it's really, really hard to do it at first. Like, people think about, like, trading like it's this magical money box, and you throw some money into this stock and it goes up forever and you make billions of dollars. you know where in reality, like, it's not. It's this thing that, just like anything else, takes a lot of time, a lot of effort. And once you start to learn it and start to understand the risk management part of it, because I remember the best thing that ever happened to me was when I started trading. Every damn trader I would go to and be like, hey, like, can you teach me some things about trading? And they would, like, send me some fucking book on risk management, and I would want to, like, burn it or throw it at a wall or something and be like, tell me the secrets. Tell me the secrets about trading. Tell me, like, you buy this. Tell me what to buy. Tell me what to do, and really, like, they were telling me the secret. The secret is risk management. Because at the end of the day, it's like, even the 60% trader winning 60% of the time in a year, that doesn't mean you even made money. Like, you can also win 60% of the time and lose money. There's traders I know who have a 30% win rate, and I've had years with bad win rates and also have made more money in those years than other years. So I know it's not about, your win rate isn't going to make you a great trader. It's putting on the positions. For example, if I put on, let's say I have 10 1% losses in a row. So I lost 10% on my account. And then I have this trade in something like Bitcoin, which makes 50% of my account. Then I have a great return for the year, like, because most of the time, 2 or 3 trades are going to make your whole year. Like, it's not the fact that you're going to sit there and put on trade after trade after trade and make this perfect 5% average and so on. Like, nothing's like that. Some of these trades, and that's really what we do as traders, and that's why I always say it's called hunting for outliers. Like, we hunt for outliers. We are on the hunt with our scopes, looking around, trying to find these outliers. And the only way you're going to find them is by putting on the positions. You're never going to know where they're going to come from. You don't know for a fact that, I think it was 2020 that lumber was going to do so well and Bitcoin was going to do so well, and some of the ag commodities, and then energy and so on. Like, you didn't know that then. And then 2021, I didn't know that this crazy trade in the commodity space was really going to take over and going to continue to move. All the signals were long, all the positions were on, but I didn't know that could have ended. The Fed could have raised rates then. They started calling inflation transitory, and they didn't do it then. And then you get into 2022, and the world's falling apart. but the commodities still continued to go crazy. The first quarter of that year was crazy for commodities. Now, for me to come here today and say I knew all that was going to happen, that's bullshit. I didn't know any of that was going to happen. I just had the long signals on and was sitting in the long signals because that's what my signals and my system told me to do. And I have the faith in my systems from back testing, trading for so long, and reading so much about trading that I have the faith to hold those positions and do what I do. And not to mention, holding those positions is only one aspect of it, but the trailing stop loss is the biggest part of it. So I know that I always need to stop. I know I'm in futures, so if I have a crazy thing happen overnight in Russia, I'm just going to get stopped out. And so all those things together adds to what I do, my system, my methodology, and the reason why I'm able to hang on to some of those trades.
Yeah, and I think that's really important. The idea that, you know, really, if we're not managing risks, there's no survivability. And I
Mm-hmm.
see a lot of people getting in trouble just saying, you know what, I'm not even going to put stops in. This is such a good trade. It's just going to work. That's exactly
Yeah.
what kills an account. Like there's no this is such a good trade. It's just going to work. It's just it doesn't work. And if you get and the really like I got to say this too. If you're one of those outlier people that you've had that happen, and so
Mm-hmm.
then your expectations have been conditioned accordingly, that you think you just got the Midas touch, be
Yep.
very careful because that's the exact environment where people kill themselves. Like, yeah, let's say you just 20x your account and you're like, it's an extraordinary achievement for anyone. That's awesome. But that also means you're on such a roll that you're probably not managing risk the way you should be, and you're probably employing too much size. So take a step back and ask, and this is a question we've talked about a lot in the early days of trading. People need to ask themselves, is this repeatable? Do I
Mm-hmm.
understand why I'm doing this? Do I understand how to be consistent? And do I know how I'm not going to blow myself up? Because what if one's making gains like that? It's probably very concentrated. It's probably very large, and it's probably over trading. And
Yeah.
those are three things that yes, you can make a lot of money, and some people are very good at it, but most people emotionally exhaust themselves and blow up in the process.
Yeah, great point. Because I mean, I can't tell you how many times I've seen that same scenario where somebody has these really, really insane returns for 6 months. I mean, 2020, everybody in the world who bought options could have had insane returns just going long anything about
Yeah.
that time, and we saw a lot of that. People who'd never been in the market before start dumping all their money, or the whatever loan they got, or unemployment or something. And people were dumping everything they had into the market at that point, and it was making them more money. So everybody thought they were geniuses. 2021 comes along, the rally ends up getting really thin. It ends up going into financials, energy, industrials, and then it starts to get thinner. And then the only thing that really was going up by 2022 was energy. They lost everything by that point. It was very hard because they were picking random stocks, like we talked about earlier. So picking random stocks is very hard. They're picking random stocks. They're losing all their money. They're way too concentrated. They're over trading. They're trading too big. They think they could just buy every dip and it's going to come right back up. And it doesn't matter what it is. I mean, I just talked to my my accountant the other day, and he was telling me about his trading. And I was like, yeah, how's it going? And he was like, yeah, like, so basically what I do is I buy a bunch of things, and then when they turn green, I sell them. And like that, but that's also, he started in that era of 2020 where like that's what he was doing then. And so now he's like, the market's changed, it's a lot tougher, the rally's really thin, so that's what he's doing now. And like it's like you gotta really like, this isn't that easy. This isn't that easy that you wait till things go green. Some things never go green again, I can promise you. Like
Yeah.
like been there, like things never go green again. But I think over everything, the most important thing to take home from this is that there is no trade that I put on. I mean, even if I put it on, like let's say I'm somewhere and I get a signal for a trade, because this happens all the time, every day. Not every day, but once a week usually. I'm somewhere random, I'll get a signal to put on a trade. I'll put on a trade. Uh, I'll put on a stop loss the second it's filled. And then 2 minutes later, I go back and check it. Like, did I put that stop loss in? Like,
Yeah.
because it's always, that's the most important thing in the trade. Like, it isn't the position I put on, It isn't the, thinking about how much money I'm about to make. It's the stop loss.
Yeah. 100%. Well said, Jason. This has been a great conversation. I really appreciate you joining me and talking about all this today. I think it's good material for people of all skill levels because one thing that's true in the world of finance and really everything else in life is we can't stop learning. We can never be satisfied with what we know and expect to do well and expect to improve. So, one thing about this journey of trading, of taking control of one's financial destiny, is never being satisfied with what we know, always wanting to be a better version of ourselves. Just like you were talking about earlier in this conversation, the real competition is, can the me of tomorrow be better than who I am today?
Yes. Great point.
And Jason, let's do this again soon. It's always fun to catch up and talk shop, and we've got a lot more to discuss. It was great to talk more about the first half of the year and what you've been doing and what you see. And I think we should keep this conversation going.
Absolutely, man. Thanks for having me on. As always, it's great to chat with you, and we'll talk soon.